Hi, this is James A. with Full Capital, and I got Fritz with me with Colliers. Fritz, thanks for jumping on.
Hey James, thanks for having me.
Yeah. Well, to kick it off, give people a brief intro just on yourself, and then we'll talk a little bit more about Colliers.
Sure. Yeah, for sure. I've been with Colliers now and Professor Doherty for just over 10 years, 11 years now. Crazy how much time flies. I focus primarily, and the firm focuses primarily on multifamily financing. We have a Fannie Mae DUS license as well as a HUD FHA license. Um, I've been really active over the last 5 to 7 years in space, especially in the B and C space throughout, I would say Texas. Love working with James Zhang and the team at Old Capital. Really excited to be a part of the conference. It's always one of my favorite events of the year to get everyone together. It's super beneficial for people who throughout the industry kind of totem pole, whether you're on the property management side, lending side, investment sales. You can make a lot of introductions, even if you're new to the business. It's really beneficial.
Yeah, I mean, I think 10 years ago when we were up in Minneapolis, we threw this idea around and you were supportive. So we did the first one. So we are very grateful that you guys were supportive of the idea and able to help sponsor the very first one back in 2017.
Oh
So
yeah,
yeah, this will be our ninth one. So it'll be definitely appreciate that. So well, let's get into what Colliers does on the mortgage side and sort of what you guys focus in on. You touched on it briefly, but maybe talk about your main role there and sort of the sort of I guess box for the lending
sure.
side on that. Yeah.
Yeah, so we can with our licensing, we can really lend across the country. Historically, it just seems like with our client base, we've done quite a bit more B and C multifamily housing. We definitely still do plenty in the A space, but just that seems to be the book that we've kind of done historically. But yeah, like I said, all around the country, I play quarterback. I like to say I'm on the production team and have a full team of called 4 or 5 people that just work with me. We kind of take it from sizing up front through the whole due diligence process, work with our credit teams and making sure we have a smooth and as seamless as possible closing.
So your predecessor Doherty was based in Minneapolis. Is Colliers based in Minneapolis, or are they
Yeah,
based
the
in?
mortgage company is still based in
Okay,
Minneapolis.
okay, but you
Yeah,
are
and then
here.
the parent company, yep, I am in Dallas. The parent
Okay.
company, Colliers International, is based out of Toronto.
Okay. All right. So I mean, the first quarter has been, I guess, I don't know what the right word is, volatile,
To say the
in terms of,
least.
yeah, to say the least. Like what types of deals sort of got done first quarter? Like talk about maybe some acquisitions, some refinances that you guys got done, and sort of the structure of those. Like what are a lot of people doing right now?
Yeah, so I would say historically, if I look back like over the last 10 years, I would say we've done probably 60 to 70% acquisitions, the delta being refinances. And I would say what we've seen is it's, inverse. So even maybe more so, maybe 75% refinances, 25% acquisitions. I think on the acquisition side, you're seeing more in the call it the B plus to A space, where it seems like there's a little bit more of a bid. You can get great, agencies are still very active. And lending in that space, you can get 65, 70% leverage. So those are kind of the acquisition deals that we're seeing where, say the buyer feels really good about the basis that they're buying it, even though if the going in cash and cash isn't as good as they want. I feel like it's still penciling from a basis play, but I would say the majority of the stuff that we're seeing is, refinancing deals off bank balance sheets, bridge loans that were originated at the peak. So many of those are, cash in refinances. I would say not many cash out refinances, hoping to be as neutral as possible. But most of them are mostly some sort of cash in.
So on those, let's talk about refinances since that's 75% of the business. On those refinances, what sort of tips and tricks do you have for people who are going through that
Oh yeah,
process? Because
for
it's
sure.
it's challenging. You're always trying to line it up, right? You've got your collections, you've got insurance renewal, you got property tax numbers coming out. It seems like something else is like coming up at any point in time. So what tips and tricks do you have for those people as they look at refinancing out
Yeah.
of those loans?
I like to say give yourself as much time as possible to get in position because it takes some time. By the time you say you do a Fannie Mae loan, by the time you kick it off, you know, do the initial sizing, get it into the agencies for a hard quote, order, some preliminary third parties, maybe get an appraisal during that process. And so once you get the hard quote and see where rates are, just try to get in position to rate lock as soon as possible. Because if you get a pullback in treasuries or collections continuing to improve, you can take advantage of it right away. Where, just recently from, recording this on the 15th, if you look back over the last week or two, there's deals that got done and got locked because they were in position and we were able to rate lock and close and take advantage of some of the volatility. And if you were just starting that process and you saw rates come down, like, okay, well, I need to refinance, but there's a lot of things that need to happen from a due diligence perspective and report perspective that it takes 2 to 3 to 4 weeks to get in a position to rate lock. And so really giving yourself enough time that you don't have to, execute within, give yourself a week to rate lock before you have a bank maturity or some other maturity where you have to do something, but really be thoughtful in getting out in front of it and be able to pounce when the deal pencils. And we had a deal, last week that if we would have locked a day later or didn't close a day before, like the deal doesn't work anymore, whether it be from interest rates, property taxes coming out, on the 14th or 15th throughout much of Texas. There's just a lot of volatility and things that can go wrong in a lot of these deals. And so to give yourself, the biggest window to execute and transact is maybe the best advice that I can give.
Yeah, I feel like like even though is there really a difference in like 525 and 530? The same way that there a difference between 4% treasury and 405 on like the 10-year. There's not that much, but like psychologically, I feel like 4%, like if it's hanging around 4%, most people are like, all right, let's go, let's lock this. So when it dropped
Hmm.
a couple weeks ago, like below four, I think every single person was like, hey, can I refinance right now?
Yeah,
Um, but yeah, I mean, we've done that and based on your recommendation to just sort of get like your third parties done, update everyone's PFS, REO schedules, get the quote from Fannie or Freddie like that you need to get and just be in position for these deals. Um, anything on I know only 25% of the deals on the acquisition side. What are you seeing on the acquisition side? Anything that maybe Fannie's leaning in more on? Do they have
sure.
like sometimes I've seen, well, I think a couple things that people have asked about is maybe the amortization, so going 35-year AM, and then also the buy down. So maybe touch on those two
Sure.
things on the acquisition
Yeah.
side.
So I would say one of the things coming out of the start of the new year with Fannie is they're really focused on. Obviously, they have their housing goals that they have to hit every year, but also they really want to focus on maybe trying to winning some newer business to maybe balance their book a little bit. They've historically done a lot of workforce housing, and one way they're trying to win some more Class A stuff is like you mentioned, the 35-year RAM has been a great tool that they've really leaned in on over the last, call it 3 to 6 months on the Class A space. Now they'll limit that at 65% of kind of value. And so they're not getting over their skis in terms of leverage, but on some deals it makes a lot of sense if you're in that. You can get from maybe low 60s with a 30-year RAM, you can get to full 65 you can get to low 60s at 60% or at 30-year RAM and get up to 65 with a 30-year RAM.
So is it
So it seems to be a
actually,
good tell.
do you actually pay 35-year AM or do
No,
you? No.
most of the times they're full term IO
Oh, it's
at
full
that
term
leverage
IO,
point.
but just sized on 35-year AM.
Correct.
I got it. Okay.
Correct. So that's one way they're trying to really be aggressive, and you're seeing that on newer assets. I would say 2015 or newer
Okay.
seems to be the flowing point. But yeah, what was the other question you had?
The other thing was just on buy downs.
Oh
Like
yeah,
a
yeah,
lot of
buy
times
ends.
people will
Yep,
ask like, hey, if I, let's say on a 5-year, like, okay, so um, before we touch on buy downs, what percentage of deals do you think are in that 5 to 7 versus the 10-year? Are most
90 to 95% of the deals are 5 or 7 year money.
5 or 7? Okay.
Um,
Yeah.
which is crazy because like if you think pre-COVID, I would say it was almost the inverse where it was like 90% of the deals were 10 and 12-year or longer deals, very, very little 5 and 7 year money. And that's completely flip-flopped.
Yeah.
But it seems to be you're still seeing a decent amount of 5 year terms, but I'm seeing more and more people kind of lean to 7.
Yeah.
Seems to be a little bit of a sweet spot. 5 years can come up pretty quick, as people are
I think on
realizing. And so,
acquisition, right? Like I feel
yeah,
like on a refi, 5 year doesn't feel that short because you've already owned it for 3 years.
yeah,
So
sure,
5 year doesn't feel that short. But then on acquisitions, the first year or two might be challenging. So let's just give ourselves a couple extra years just in case,
yeah.
runway there. So okay, so I wanted to clarify that 5 and 7 year, but okay, so buy downs. Typical, let's say on a 7 year deal, if you put a 1% buy down, what does that usually help you with?
Yeah, it usually gets you for on a 7 year call for a point buy down, that'll get you about 16 or 17 basis points
Okay.
of lower rate. So Fannie has different max buy downs. So on a 5 year deal, you can go to up 1.25%,
Okay.
which in the aggregate would get you about 20, call it 28 basis points plus or minus.
Okay.
The 7 years, 175 is the max, which gets you also in that kind of 28, 29 basis point pickup in lower rates. And then a 10 year, the max buy down is 2%. And again, that one probably gets you 26 to 27 lower in proceeds. We're still seeing it on most deals, I would say, especially if you're some sort of debt service constrained. If you run the math, it generally makes sense to pay the upfront cost for the pickup and proceeds from the lower interest rate.
Okay. And then I think before tariffs came out a couple of weeks ago, the biggest news was on the Fannie Freddie side was just this whole like privatization
Hmm.
of Fannie and Freddie. So maybe I know it's all speculation, but
Yeah.
maybe touch on what you know and what you don't know
Mhm.
on that.
Yeah, no, I think, obviously in the last Trump administration, they got pretty close to pulling them out. And at the end of the day, they didn't get it done. I think it's a priority, obviously, for the new Trump team. I think it's probably at least 2 or 3 years away from really materializing. If you think about the sophistication and the amount of just pure volume of liquidity that Fannie and Freddie provide, not just for the multifamily market, but single family is significantly larger than multifamily. Just for an example, I think single family for Fannie and Freddie is like 80% of the volume that they're due. Only 20% is multi. And so, I think it will take some time for it to happen. So if I think it does happen, it's in the later half. The one positive thing is I think it's will be similar to what they when they looked at it in the last Trump administration is Fannie and Freddie will continue to have the called the implicit government guarantee, which makes them different than just a normal CMBS shot. Is
CMBS
the
deal. Yeah.
inherent guarantee of the U.S. government behind them. And so I think as long as that stays in place, if they do go private, it'll still be in a maybe you see a little bit higher rate just for maybe a little bit more inherent risk that it's not fully part of the government. But maybe that's 20 or 25 basis points. So it's still wider, but not
Not
materially
too much.
where it would really screw up the marketplace.
So, both of us are on like the front end of these transactions, getting them done, but you still service all the loans that
Mhm.
you originate. So to some extent, and so um, you know, I get all these updates on like delinquencies on bridge loans and stuff like that, but you guys see it on the Fannie side, and what recommendations do you have for people who, they have a Fannie Mae loan and they've been in the deal for a couple years? What ha maybe some best practices of general partners
Yep.
um, on these loans because you might be in this deal for 7 to 10 years, and so you're with your servicer for a long time. So
Yeah.
yeah, talk about sort of the asset management piece of these deals or loan servicing piece.
Yeah, I think it's a really important piece of the puzzle, especially if you want to keep doing agency business. You got to make sure on the back end that you're continuing to operate these deals and take care of the collateral. because these are all non-recourse loans. So really, the lender, the only collateral they really have, unless there's obviously a bad boy act, is the real estate. And so I think the more you can communicate with your lender on kind of what's going on, if there is a problem, maybe you've had issues with vacancy or whatever, just make sure you're being over communicate to whoever your servicing contact is. And then secondly, just making sure you maintain the collateral. And I think that's something that a lot of people that will be showing up at the conference has probably dealt with over the last 2 or 3 years. Is really just both Fannie and Freddie really leaning in and saying we're really focused on asset quality, like really focused on it, especially in the B and C we call workforce housing space, making sure that these deals, are actually being maintained. And some of the things that have to get done to maintain these deals are not things that are going to necessarily get you more rent, but they're for the best long-term health of the buildings. So we saw obviously during COVID, post COVID, after the boom, that some folks just didn't have enough cash at the operating accounts to keep some of these deals up. So I would say on the agency side, that's where most of the issues were. I would say less on the delinquency side with the agencies, but more so on just GP groups just not properly maintaining their assets. And so that's going to continue to be something that Fannie and Freddie are going to be very focused on moving forward. So the more you can just stay on top of it and on just little due diligence or not due diligence, deferred maintenance items, so they don't just pile up and all of a sudden you look 6 months down the road and someone from Fannie or Freddie or someone from your servicing team drives by the property and it looks like no one's been there for 6 months.
Right.
And that's where you start having problems.
The have they changed anything like in let's say the last 12 months on underwriting, whether the borrower or the property, just because of, I mean,
Yeah,
Fannie's, yeah, yeah, just in terms of their guidelines, anything new that they've added or changed
I
on
would
the,
say if you're a newer sponsor to Fannie, I would say there's some more due diligence that they're requiring on the front end of these deals, additional bank statements, things like that, that they wouldn't for someone that they have a longer track record with.
yeah.
Um, but in general, I just think there's just a lot more scrutiny on asset quality, whether that be from the property condition assessment, and how we're underwriting, reserves or R&M, repairs and maintenance, making sure there's enough in the replacement reserve going forward. So we're seeing, the idea that it's easily going to get to 250 or 200 a unit in replacement reserves, on a 1970s or 80s asset, it's not going to happen anymore. Probably shouldn't have ever really happened, in my opinion, because these deals just require a lot more capital than, especially the older assets, than I think people are underwriting to, peak cycle.
All right. Well, you will be at the conference coming up here in October, and so I guess wrap up with any final thoughts or anything for people as they go through the next couple quarters before they see you in October.
Oh gosh, in terms of just keep Allen out there in the market. It's a and do what you can to just get in position, be proactive um, on your deals. And I think if you do that, you're going to put yourself in the best situation to have the best execution. And then for the conference, it's like I said earlier, it's one of my favorite events all year. I see a lot of industry partners from all different service sectors where you can network and get a lot of great color. And it's entertaining. Also, it's not your run of the mill. Someone's going to sit up there and you're going to fall asleep halfway hearing through from an economist. It's going to be yeah, more exciting and funny and engaging than I would say most conferences that I go to in the industry.
Well, I appreciate you coming on, Fritz, and we will see you in October.
Sounds great. Thanks,
All right.
James.
That's ya.